Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss, is oil the new toilet paper? Also, we'll take a look at dependent care flexible spending accounts, as well as Medicare means testing plan, and we'll venture on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Hanging in there, right in the middle of tax season. So busy, but yeah, it's going well so far.
All right, glad to hear it. Glad to hear you're hanging in there and doing well. All right, well, let's dive right into, is oil the new toilet paper? This was a fascinating title that immediately had my attention when I opened the Personal Financial Review. So let's dive into really what we mean around it. Of course, COVID, it was really interesting how grocery stores and such were having trouble stocking the shelves. Many items were flying off the shelves. Predominantly the one that was in the news is toilet paper. I remember literally asking my neighbor and them going, oh yeah, we got a bunch, here's two. I was like, really? So what are we seeing around oil, and what we really want to help people understand around oil, especially when it comes to the futures market?
Yeah, it's bizarre how you can have these crazy market breakdowns, right? Where something that's just like so ubiquitous, so, normally easily accessible, becomes constrained. I remember when the day we closed down the office for the pandemic, when California, put out that, the work from home order. And fortunately, Michelle had ordered an industrial package of toilet paper and was handing them out to everybody, right? Because all the store shelves were bare. But you could still get it through a business supplier, right? Instead of going to a retail. Yeah, kind of bizarre. It's kind of a funny comparison, right? Between oil and toilet paper. And they don't match up completely. But a lot of people ask, it's like, how does the price of oil shoot up so quickly, right? How does the price at the pump go up so quickly when Iran represents 1.5% of the global oil supply? Obviously the Strait of Hormuz being closed, that's 20% of the global oil supply. So you get into a bigger number. But obviously countries have reserves, other things. How does it move so quickly? And the answer is it does kind of parallel to that toilet paper comparison, because during the pandemic, supply chains are made for people to go to the grocery store or wherever and buy, kind of their 1 month supply. Right. And if everybody does that, then there's plenty of supply. But the minute that people start worrying about the future availability of something, I hate to say it, but, in their own self-interest, it makes sense to hoard it, right? Mm-hmm. To make sure that you get it while you have access to it. And so if people are going in and buying a month's worth of toilet paper, then really you can only supply 1/12 of the population, right? Because the supply chain is not producing enough. And that's how you end up with those shortages, even not counting things like the black market, right? Where people are going and trying to buy it all and then sell it as a markup. But that's the normal response that a market would have to a shortage is the price going up. Which in the shorthand is a bad thing, and the long, a little bit longer view is a good thing, in that it creates this price incentive. Suddenly it's very profitable to supply that. So maybe, in the case of toilet paper, a manufacturer would want to run their plant around the clock, right? Instead of running one shift, they run 3 shifts so that they can create the supply that's needed, which is what we would all want.
Yeah, so let's tie in the similarity here to the phenomenon in the oils market. As you said, obviously Iran produces a very small amount, but with the, I'm sorry, I'm drawing a blank on this, the shipping lane.
Oh, Strait of Hormuz, yeah.
Thank you. Yeah, that limiting it to, roughly 20%. So 80% of the oil supply is still flowing. It's just really interesting how much this actually has affected it. So, how do we take a look at that? Because we saw a big jump in a matter of days from the price of oil.
Right. Yeah. The price per barrel of oil. I mean, there's a number of different indexes that you can look at, but basically went from around $60 to over 100 within a few days, right? And so, how does it move so quickly? But in a way, it does make sense, right? If you're a business and oil is a key input, you can't risk, not being able to access supply. You can't be sitting around twiddling your thumbs, paying all of your expenses, but not bringing in any revenue because you can't get a key input. If businesses were to allow that to happen, obviously in the short term, they'd probably take big financial losses. In the long term, they could go bankrupt. So it incentivizes businesses to hoard oil, right? And not just oil that's available right now, but oil that will be available in the future.
Yeah.
And that's where the financial markets get interesting is that, you can access future oil by going to the futures market and basically, today committing to buy oil at a future time, that will be delivered, in the future, according to certain rules of the futures contracts, which usually means, delivered at a major oil hub on a given day. And so it makes sense that businesses would, buy these oil futures even at a higher price just to make sure that, they have this contractual access to oil, not just today where there's probably not a real big shortage just because of the short time period, but going out months just to be safe.
Yeah, can you differentiate between the futures market and spot price? I think it's important to this discussion.
Yeah, spot price is what you buy or sell oil for today, right? So that's actual physical oil for delivery right now. Futures markets, you're going out at some point in the future, right? It could be delivered a month from now, 2 months from now, 6 months from now, whatever. And you could actually string together a lot of different contracts for each time period that you want that oil to be delivered to know that you're going to get access to it. Um, Typically the futures price is a little bit higher than the spot price. One, it kind of just makes up for the time value of money, right? The interest, but in these cases where people are worried about the availability of future oil, those futures prices can get a lot higher. And unlike toilet paper, where people that were hoarding had to find somewhere to store it all, you're not storing the oil, right? Because it hasn't even been delivered yet. And so it doesn't create that, that choke point. But, when the futures market goes up, it creates a financial incentive for people to arbitrage. If I have oil today, I may choose to just hold on to it. And instead of selling it today, enter into a futures contract to sell it a month from now. If the price is high enough that it's going to pay me a really good premium to store it, then I would do that, right? And then also those future markets, they're going to have global repercussions because even though the oil U.S. is a net producer of oil, and we do produce a lot of oil here, you may have other places like South Korea that are heavily dependent and don't produce oil. So, their futures contracts may go up, up, up. If I'm sitting here in the US, I may say, it makes sense for me to, take that oil and ship it to South Korea. If their futures contracts are high enough that it's going to compensate me for the cost of shipping, plus profit. And so what that'll do is that'll pull up the price in the US and pull down the price in South Korea, till it, basically reflects the difference in the cost of shipping, along with, a reasonable profit margin.
Yeah, yeah, it is fascinating. So when we speak of the spot price, is that what we're referring to when we say, that shift in the cost of a barrel of oil from 60 to 100?
The spot price did move up, yeah. But typically when you see an index, they're looking at the near-term futures contract.
Oh, okay.
Because it's more heavily traded, it's more standardized, it's an easier way. I mean, obviously, the spot price of oil can vary significantly based on your location, type of oil, a lot of different things, and doesn't generally go by the same, standard definitions. So typically when we see an oil index, it's the most near-term futures contract because it's a little bit more accurate idea of at least the financial how the financial market is valuing the oil.
Okay. Yeah. Thank you for the clarification on that. So, oil's really interesting in that I don't know how many things that are traded are inelastic as far as around the demand.
Right. Yeah. So, that's one of those crazy economics terms, right? Elastic or inelastic goods or services. And oil is usually the example of an inelastic market. What that means is an inelastic product is one in which the demand changes very little in response to a change in price, right? So most other goods, if the price goes down, demand goes up, right? If it's cheaper, people are like, yeah, I want more of it, right? If it's expensive, people say, I want less. It's just, it doesn't seem like a very good deal or it becomes unaffordable. The problem with oil is because it's a necessity and there's so few viable alternatives, demand doesn't change very much compared to a change in price. I mean, we might see a little bit, you or I as consumers, if prices are high, we might drive a little less, right? Think, okay, maybe I don't need to, take that road trip, or maybe I'll try and cut back on my number of trips to the store or something because it's costing so much to fill up at the pump. But most of the major uses of oil, it just doesn't change the demand. So as the price goes up, you don't see a reduction in demand to limit the amount of that price increase. And so therefore, when you have any risk of a shortage, you can see what we've seen, which is the price moving up very quickly. Of course, you can also see it on the other side when you have a strong increase in supply, because demand doesn't necessarily change that much, right? Just because there's a high amount of supply, doesn't mean people are suddenly going to start consuming more.
Right.
You can see a pretty big drop in prices. So it does become a very volatile market from that standpoint.
So oil, if we think back to our high school economics class, the supply and demand curve, it works a little bit different than the standard model by which we used to look at things.
That's right. You get a demand curve that is very vertical,
Mm,
pretty straight up and down in terms of, the change. So the price change is mostly dictated by supply.
yeah. So
Uh, and
it,
so
Go ahead. Sorry.
And so with the shortage in supply, right, we're seeing price can move up very quickly. And we've seen that in the past. If you go back to in 2000, roughly, price per barrel of oil was like $18 a barrel. And there was very little investment in finding new supply, right? And so, because of that lack of investment, and supply was flat to even down, because the thing with oil is if you're not investing in finding new oil, you're having, wells run dry, right? Supply will actually decline. And so it ended up in this supply demand mismatch where, by 2006, oil was at $125 a barrel. So within 6 years, we saw this huge run up, and it was because of a lack of supply keeping up, right? But then that those high prices triggered a huge amount of investment in new oil, and including fracking technology, which probably never would have happened at low oil prices. It just would not have been worth the investment to try and figure out this new technology and develop the infrastructure. But at $125 a barrel, it made sense to take those risks. And that brought, a huge increase in supply. And so eventually by 2016, oil was hitting $27 a barrel.
Yeah.
So, I mean, that's a longer term price swing than what we've seen. But obviously you can see the huge impact that either an increase or decrease in supply mostly, demand tends to tick up a little bit over time, right? With population growth and economic growth doesn't tend to change very rapidly in the short term. But supply can change pretty quickly, either in the short term, as we're seeing now, or sometimes over a couple decades, through these kind of secular forces in terms of how much investment is going into the oil and gas industry.
Yeah. Anything else you want to add before we move to our next topic?
Well, just that, we have to hope that the current supply disruption is fairly temporary, right? Because, we could see prices drop very quickly if that's the case. But if we see a prolonged conflict or major damage to or destruction of critical oil infrastructure, that could lead to a more durable price shock. And the challenge is, just as demand doesn't really change in the oil industry, supply, can't change that quickly, right? It takes a lot of investment and a lot of time to bring new oil to market. So this is something we'll have to watch very closely. I don't know about you. I spent the weekend, diving into everything I can about the U.S.-Iran foreign policy, every think tank, et cetera. I don't think I'm any smarter from having done it, because it seems like every think tank contradicts each other, or has different views. But just trying to get some understanding of what the potential implications are, and especially the duration of the disruption we could see to the oil markets.
Right, right. All right. Well, let's jump to dependent care flexible spending accounts. Many large employers offer their employees flexible spending accounts, FSA, as an employee benefit. So these accounts allow employees to defer a portion of their salary on a pre-tax basis to an account that can be used to pay for qualifying expenses without being taxed on the income. Awesome stuff. What do we really want to help people understand as far as what is a qualified expense if you have access to one of these flexible spending accounts?
Yeah, so let's kind of back up. We'll talk about what things have stayed the same, right?
Okay.
So basically, the idea is if you have child independent care, right? So if you're working, or if you're married, both you and your spouse are working or looking for work, right? So if you're in between jobs but you're out interviewing and things, you can still qualify. And if you're paying basically childcare expenses, right? Qualified childcare expenses to someone that, is, doing this as a business, gives you their name, address, tax ID number, everything, so that you can report it. There has historically been a tax credit for that. So you can claim, $3,000 per dependent up to a maximum of $6,000, and get a 20% tax credit for the amount that you pay. So basically $1,200 off your taxes, right? Pretty generous. So that has remained the same. And pretty much everyone has that option, assuming they qualify based on income and other factors. But for people whose employers offer flexible savings accounts, as you mentioned, or flexible spending accounts, sometimes they're called, they may have another option, which is to defer some of their income. Their employer basically holds on to it pre-tax, right? So they're not taxed on that money. And then they can take withdrawals out of this account to reimburse themselves for certain expenses, one of them being child and dependent care. So the change is that in the past, the maximum that could be deferred under that type of program was $5,000. In 2026, it was increased to $7,500. So it was always kind of weird, because the 5,000, if you took the 5,000, the dependent care credit goes up to 6, so you could still claim another $1,000 of that credit, right? So you kind of, double dip. And now with the employer amount being 7,500, obviously that'll be, entirely in lieu of taking the tax credit, because it's a larger amount. And it offers a double benefit in a way. So typically what we would look at is individuals' tax rate.
Okay.
So if you're in a 12% tax rate, fairly low income, you probably want to claim the credit, the tax credit, because you're getting 20%. So rather than saving your 12% tax rate, take the 20% credit against your taxes. It goes further. But if you're in a 22 to 37% federal tax rate, that flexible spending account is better, because you're basically saving your tax rate. You're not paying taxes on that income that would be taxed at that higher rate. And of course, now with, the higher limit of $7,500 makes it even more attractive. So it's definitely something that people should consider, and, may even make sense to, adjust their strategy a bit for some.
Now, this prompts the question for me. Obviously, this is something you have to preemptively do and utilize. So this is a pre-planning strategy when it comes to taxes. This isn't something that you can retroactively go back and go, hey, no, open that account for me so that I can get the savings. So you need to be kind of aware of what your annual projections may be. Am I correct on that?
Exactly. Yeah. So you want to sit down and figure out what your costs of daycare. It can be before or after school care. It could be summer camps, things like that, all qualified. But you want to have an idea of what your spending will be, because you do have to defer the money into the flexible spending account ahead of time, right? It has to, come out of your paycheck rather than that amount being paid to you. The other thing is, FSAs are a use it or lose it account, which means if you allocate a bunch of money and then you don't have the qualifying expenses, you don't get reimbursed. So you maybe don't get taxed on that money, but you lose it. So, you want to make sure that you take qualified distributions within the plan year, which in some cases may include a little bit of a grace period, but for the most part, it's an annual thing where if you're going to put a full $7,500 into an FSA, you want to make sure that you're going to have at least that much in qualifying childcare expenses.
Yeah, well, as stated, for a flexible spending account. So we want to keep that in mind. Not a savings, a spending.
Right. Yeah, because you can't roll it over. So yeah, it's basically pre-funding anticipated spending.
All right. Anything else you want to add before we move to Medicare means testing plan?
Just, with these changes, they can be a little complicated. It makes sense to talk to a tax professional and say, what makes the most sense for me, right? With the risk of, okay, I have to plan ahead. Does that make sense? And then how much, would the potential savings be? And does that compensate for, potential added risk of maybe you don't incur those expenses?
Yeah. All right. Let's dive into Medicare means testing planning. We've touched on Medicare quite a bit, some of the complexities, but what are we wanting to understand around this means testing? I know that you mentioned Medicare Part B and Part D premiums, and sometimes people can get a little bit overwhelmed.
Yeah, and we're just seeing more and more people being hit with this, right? So it's a new thing for them, and obviously nobody likes to pay more in insurance premiums while not getting any more in return. If we go back the IRMA, the Medicare Income Related Monthly Adjustment Amount, this goes back to the Affordable Care Act, right? So how they paid for the benefits that people get under the health exchange. They created a system where if your income exceeds a certain threshold, then you pay an additional amount in your Medicare premiums. And what they did is they set those income thresholds and they froze them for the first 10 years. So they didn't go up with inflation. So as people's income typically goes up with inflation or with market returns, things like that, it kept getting more and more people would fall into this IRMA. And then after the first 10 years, it's now adjusted for inflation. So, the threshold does go up every year, but a lot of times people's income may grow faster than inflation if the investment markets have been doing well, or, they may just have a given year where they sell some real estate or they had some significant gains on their investments and they go over the threshold. And so then what happens is they get this letter from the Social Security Administration saying, this is how much more we are going to deduct out of your Social Security benefit this year, or put it another way, this is how much less you will receive in your bank account because of these deductions. And a lot of times, one, people are wondering, well, how did this happen? How does this work? But two, a lot of times it comes as a surprise because it's basically based on the income from 2 years prior, right? Because you're filing your taxes, they're being processed, obviously, in the year after, they're being processed. And then the IRMA doesn't apply until the following year when it's applied. So, for this year, 2026, whether or not someone's being hit with that additional IRMA Medicare premiums is based on the income that was reported on their 2024 tax return. Now, maybe 2024 was an outlier. Their income was higher than normal, and in 25 it was lower, right? But that won't reset until 2027 based on their 2025 income. So yeah, just kind of trying to help people understand, the differences. There's 5 different tiers of IRMA too. So sometimes people, their base income might be over the first tier, but then depending from year to year, they may bounce around within the tiers. So their Medicare premiums can change quite a bit from year to year. It also can have the implications of changing the tax withholding on their Social Security because,
Right.
if you're getting Social Security income, they subtract out the Medicare premiums first, then apply the percentage tax withholding that you've elected. Well, if your IRMA goes up, right, then your tax withholding is going to go down, which then could cause you to owe a bit more on your taxes as well. So these changes, you do want to, keep in mind that as these changes occur, you want to make sure that it's not negatively affecting other areas that could have more broad implications as well.
Right. Yeah. And necessary to keep in mind that how backwards looking it is, obviously, when it comes to tax planning.
Yeah, and the other thing that I'll throw in is there are some cases where if you have a significant change in circumstances or maybe something that's uncontrollable, you may be able to contest the IRMA with Social Security, right? So let's say you were working, not claiming Medicare benefits, and then you retire and claim Medicare benefits, right?
Mhm.
Well, that last year where you were working, your income may have been much higher, which would cause the IRMA to apply 2 years in advance. In that case, you can write to the Social Security Administration and say, "Hey, look, that's not reflective of my retirement income. I've had a change in life circumstances, and my income will be lower." And typically in those situations, they're pretty good at adjusting the IRMA down to that more steady. But on the other hand, people have tried and said, "Hey, I sold a rental house and I made a bunch of money. That's not going to happen again. That's unusual." They say, "Yeah, tough luck, right? You chose to do that. You chose to do that. You generated the income. You made the money. You're going to have to pay the IRMA at least for a year."
Gotcha. Thank you. All right, let's jump into the Plan Solutions Incorporated Office Bulletin Board. We've got 2 items pinned up there. What do we got first?
Yeah, so we've got about a month left in tax season, right? So, anyone that is planning on having Plan Solutions do their taxes, basically implore them to please get going on it. We've talked about this in the past. Every tax season has its own personality, right? It's just, you never know. There's no pattern to it. It can be based on when forms come out. It can be based on just, when, the majority of people get motivated to sit down and do their taxes. Sometimes it's when holidays fall, right? And obviously people may not be working on their taxes over those weekends. This year started out a little slow. And so we're not that we're behind in terms of on the work, we're behind on probably where we should be at this point, and spreading out the work. So I would really appreciate, if anyone, has just kind of been putting it off, but has the time, if they can get us the information or at least as much of the information as they have available, that would be really helpful because every tax preparer, tax advisor's nightmare, right, is that everybody waits till the last week in April. And if that happens, we just won't be able to get all the work done. So any help there would be appreciated.
Yes, sir. Next, Joel attended an economic update symposium. Tell us about that.
Yeah, River City Bank, and there's a number of different kind of local banks. A lot of the local regional banks are heavy lenders within within the local area, right? Especially on things like commercial real estate, business loans. And so they'll do these events, that highlight both the Sacramento or whatever region they're in, their local economy plus the national economy. And they're always really interesting to get, kind of a different perspective, different takeaway, and often kind of the highlight of the local economy, which typically we don't focus on a lot when we're looking at national trends and things that affects the financial markets. But yeah, he reported it was very interesting. Basically the takeaway was that the economy came into the year on a really strong note, both nationally and for the local Sacramento economy. But a lot of the fundamentals that were driving those positive trends are still in place, so they haven't really changed. But obviously, the recent uncertainty, makes the outlook a little less clear. especially around, oil supplies, oil prices, and the broad impact that that could have. Um, the U.S. debt and deficit, right? Something that's maybe a longer term risk, but continues to hang over and makes us nervous. High stock valuations, not that they are crazy high, but they are, somewhat above average. And so that's always a risk. And then just, government policy risk, right? The volatility of some of these changes that continue to be a concern. So, all in all, an interesting take, aligns with a lot of the things that we at Plan Solutions talk about in our investment committee meetings. So, it's always positive whether you get some new ideas or some new perspectives, or just to kind of reinforce and say, okay, maybe we're on the right track because other people are seeing the same things that we are when they go through the data.
Absolutely. Well, thank you, Chase. Anything else you want to add in closing?
Hope everyone has had a good St. Patty's Day. I guess that's over. I screwed up and I got my dates mixed up and wore green the day before, and I really only have one green shirt, so I was kind of in a tough spot. But yeah, good St. Patty's Day, and happy Easter, and hopefully a great spring. I know we're getting a great spring here. Elsewhere, people are getting late snow and things. So, but yeah, hopefully good weather for everybody soon.
Yes, sir. Yes, sir. I lucked out. St. Patty's Day, I worked by myself from home, so I didn't have any interactions with anyone that day. But thank you all for listening to the Plan Solutions Incorporated podcast, of course, on Apple Podcasts, Spotify. If it's your first time, please hit that subscribe button and share it with somebody else that you think will get value out of it. We don't do any external advertising, so our growth is through word of mouth from you, and we thank you for that. As well, you can go to youtube.com/@Plan Solutions if you want to watch a visual form of the podcast that includes the personal financial review, the written content that we discuss here that comes out bi-weekly. And if you have yet to subscribe to the personal financial review, it's simple. Just send Katie an email, katie@plansolutions.com, and let her know you want to get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.